You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey of the Wealth Formula Podcast coming to you from Montecito, California. Before we begin, I want to remind you that there is a website associated with this podcast called wealthformula.com. Lots of resources there. It's also an opportunity to join some of our various groups, including the Accredited Investor Club. If you are interested in potentially seeing some deal flow come through and you are an accredited investor, get onboarded by visiting wealthformula.com and signing up. As for today's show, we're going to focus a little bit on sort of how to potentially recalibrate the way you look at investing. You know, as intelligent people, we often overcomplicate things. Whether it's business, health, relationships, we're constantly seeking advice, following trends, and trying to use complex strategies really to optimize our results. And as you may know, I'm deeply entrenched in the longevity space. As a physician and science person, I am fascinated by this stuff. And while there are all sorts of supplements and tactics that could incrementally add to our lifespans, right now, it's pretty clear that the most impactful things that you can actually do to live a long, healthy life are to focus on the basics: a good diet, lots of exercise, and really good sleep. Of course, each one of these things is complicated. They're not that simple. And I have a lot to say about that. So if you want to check out my podcast, for example, Longevity Junkie with a Y, that I do with model Nikki Lee, you can go ahead and check that out the same way you listen to this one. Anyway, as is the case for most things in life with these health fundamentals, getting down to the basics is often what matters. And it's not actually hard to see that. In personal finance, the principles can also be pretty basic. For most of your investments, and I say most because obviously there are situations where you purposely break these rules, but as long as you know the rules, you can break them as all you like. But for most of your investments, the idea is simply to stay disciplined, rely on data, and avoid the allure of the next big thing. So this week, I talked to someone who practices the art of sticking to fundamentals while challenging the status quo. And while this guy's expertise may focus on public markets, the lessons he shares apply to really any investor. So whether you're buying rental properties or managing a stock portfolio, it's a really important conversation and one you're going to want to listen to. And we will have that right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key: even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Dan Rasmussen. He's a founder, portfolio manager of Verdad. Before starting Verdad, Dan worked at Bain Capital, private equity, and Bridgewater Associates. He's the chairman of the investment committee for Plymouth Rock Companies. Dan is a contributor to the Wall Street Journal, and his investment research has been featured in multiple volumes of the best investment writing. He has a bachelor's degree from Harvard, summa cum laude, Phi Beta Kappa, and an MBA from Stanford. He's the author of The Humble Investor: How to Find a Winning Edge in a Surprising World. Dan, welcome to the program.
Thank you, Buck. It's nice to be here.
So with that background, I just want to ask out of curiosity, how was your time at Bridgewater Associates?
It's a fascinating place. I think there were some elements I really took away from it in a positive sense. I think, Ray Dalio's obviously written and spoken so much about his principles. I found culturally I perhaps was misaligned with the principles. But I thought applied to investing, there was some really great core insights. And the biggest of which I think was to say that every investment you make should be based on a system, right? You should say, what is the logic behind the investment I'm making? And would that same logic have worked over the past 100 years if applied in a consistent, disciplined way? And that's such a simple idea, but it had such an impact on me because it gave me a way of saying, when I'm thinking about an investment, rather than just, how do you approach a new investment? And I think what I took away from that was, you want to say, well, what's the logic behind this investment? And then think in some way, how can I evaluate the quality of that logic? And I think that's such a better way of thinking about investments than just looking at everything on a case-by-case basis.
Yeah, absolutely. So let's look into the counter of that. What are some examples of, even at the institutional levels that you've been at, situations where something may have seemed like a good idea to invest in, but in hindsight, really did have some potential logical flaws? Can you think of anything like that for us?
Yeah, I think there's a lot of good examples. I mean, I think that one classic example, we've had a series of what I'd call investment fads where you thought you could do well by doing good. And the first of those was the emerging market wave in the 2000s. And if you think back to the logic, everyone said, well, if we invest in emerging markets, we are going to help lift these countries out of poverty. And as they become more capitalist, they'll become more democratic and more aligned. And so by investing in, infrastructure in China or Pakistan, over time, China and Pakistan the people will get richer. And then not only will they get richer, they become U.S. allies. So let's put huge percentages of our portfolio into emerging markets. And that was one of the big ideas of the late 2000s. Harvard Management Corp put 20% of their portfolio into EM on the basis of that story. You fast forward 10 or 15 years, you have the big ESG wave where people are saying, hey, let's dump money into stocks that have good environmental, social, governance scores. And I think in both cases, a rigorous analysis would have suggested a different answer. I think in the case of emerging markets, what you would have said is, hey, as a rule, is investing in, low GDP per capita countries, has that been a good thing or a bad thing for portfolios over the long term? And the results you would have come out with was that it was wildly volatile. That many of these countries had crashes that they never recovered from. And that the risks of putting your money into, Pakistan or, even China were massive relative to keeping it in safe, developed countries like the United States or France or the United Kingdom. And I think when it came to ESG, there was lots of evidence and any sort of systematic study that, for example, take governance. Who's on the board of a company has almost no impact on the stock price's performance. By the way, who the CEO of a company is has almost no impact on how the stock price of a company does. I've done a ton of research on this, right? You could segment it out, whether they worked at a McKinsey, whether they went to Harvard, anything you can divide out. None of those sort of background things predicts who's going to be a good CEO or who's going to be a good board member. And even if you could connect the board member or the CEO's, performance to the stock price performance, which I think is hard. And so I think those are things where you just say, hey, let's take a razor to this idea. What are we really arguing? In the case of emerging markets, we were arguing to put money in low GDP per capita markets with a short history of actual equity ownership. In the case of ESG, it was to place a large amount of emphasis on who the people involved were at the top level in terms of social and governance. And I think in both of those cases, there were wrong-headed premises that led people in the wrong direction.
In hindsight, if you go back and look at those, I think you say, first principles here, what's the likelihood of us making money and what are the obstacles? And then go back and see if you're doing what you want to do as a side effect. That would probably be a better approach, correct?
Yeah, I think that's right. And I think a lot of my book, The Humble Investor, it stems from a lot of work that a guy, Philip Tetlock, did about forecasting. And Philip Tetlock did this study where he said, take the world's leading experts in a variety of fields and have them predict what's going to happen in their area of study. And he found that, in fact, these experts were no better at predicting major events in their fields of study than just random chance or undergraduates. But his conclusion, you could say, well, therefore, like the one conclusion would be like the future is totally unpredictable. It's a position I call future nihilism. I mean, other people have used the term, but future nihilism. We don't know anything about the future. We can't predict anything about the future. But Tetlock goes one step further and he says, well, gee, actually, there are some methods that lead you to make good forecasting decisions. And one of those is this idea of base rates or historical probabilities. So it's sort of reasoning by analogy at scale, where you say, let's say his classic example is that you're going to do a renovation on your house. And you have the contractor come in and the contractor tells you, it's 5,000 square feet and it's going to take 12 months to do or whatever. And you come back and you say, well, how do I know it's going to take 12 months? One way I could ask him to give me all the detail of his projections, or I could say, what's the time per square foot of your last 50 projects?
Yeah, right.
That's the historical probability of the base rate. And that's the method that works. And so it's don't, when you're thinking about investments, don't say, how do I think through this whole story in a very logical, clear way, but rather think, let's fit this story into a pattern. What type of thing is this and how have those types of things performed over time?
Sure.
And what can I learn from that?
I mean, at both sort of this larger institutional, or I don't say institutional necessarily, but, like offices like Bain, private equity, or with Ray Dalio, at that level, hubris is still an issue, right? It's not just a problem of individual retail investors thinking they know a lot, that kind of thing. It happens at all levels.
It happens at all levels. It's human nature, and I think the masters of the universe are perhaps more guilty of hubris than your individual investor, right? And you look at it, and I'll give you another great example, right? You take the sort of best, greatest minds of investing today. Who would you think of as sort of the best allocator? You'd say, well, it's got to be the college endowments. It's Harvard and Yale and MIT. And then you think, well, what about let's take another extreme group of people who I think are humble investors, the Bogleheads, who said, hey, just dump all of your money in a 100% equity passive index fund and just let it sit and never do anything with it. And a guy, Richard Ennis, who's a really sharp guy, came out with a study recently that found that if you had put your money in an 85% stock, 15% bond portfolio 20 years ago, versus if you'd put your money with an average of all the Ivy League endowments, you would have done better in the index funds. Right. And it's an indictment again of hubris, of thinking you're going to outsmart everybody else, versus saying, what if I can't outsmart anyone else? Right. What if the future really is much less predictable than I think? What are the actions I should take that follow from that? Right. What if starting from that premise, and starting also from the premise that, by the way, everyone else doesn't know what they're talking about anyway. Right. Like, my financial advisor doesn't know what the stock market's going to do next year, and neither do I. And so what can I take away from thinking through the implications of that humility?
How do you shift from valuing sort of the individual's views versus market views?
Yeah, it's a great question. So I think the one of the ways that I think when I write about getting an edge, right? Getting an edge from humility, which seems like an odd idea. One of the ways I think you classically would think about getting an edge from humility is to say, well, let's find the places where other people are arrogant and bet against them. What are the things that people are most confident about? And we're going to take the other side of the trade. And I think one way to you'd say, well, what if I only had some measure of where the market was most optimistic or pessimistic? That's sort of what I need. And I think that one classic measure of optimism or pessimism is valuation ratios. So where humility leads me is more towards being a classic value investor, of saying, well, gee, if the net present value of future cash flows is what's being priced into a stock, then the stocks with very high valuation ratios are the ones where people are forecasting very wonderful things. And the more extreme the valuation ratio, the more confident those people are in their forecasts. And then conversely, on the other side, the very cheap and expensive companies, are clearly pricing in very bad outcomes, and people are very confident in those bad outcomes. So if you go long, the things that people are most confident about are going to be horrible, and short, the things they're most confident are going to be wonderful. You've created a humble portfolio. And I think if you look out today and say, well, where are people most pessimistic? Where are people most optimistic? I'd say the story is so simple today. It's so clear. And I think, sadly, passive investing is partially to blame. And the reality is that U.S. large cap growth, the Mag 7 plus names, are where people are most optimistic, where valuation ratios are absolutely the highest, where they're reaching the highest valuation ratios have been on any metric over 20 or 30 years. And if you go anywhere outside of that, you decouple anywhere from that, you go internationally, especially you go to Europe, you go to Japan, you see very low valuation ratios. And the reason that passive is playing a role in that, and passive is a very good idea, right? You want to, passive investing is a wonderful innovation. But the problem with passive is that when people think passive, they don't think, the developed X world mid cap index is what I'm going to dump all my money in. They think of the S&P 500. And so as people have gone passive, which was a good thing to do, they've herded into a smaller and smaller slice of stocks. And that slice of stocks, the valuation ratios of those stocks have sort of taken off at the same time as that shift has been happening. So I think today the one classic mistake that people are making is having too much of their portfolios concentrated in large cap U.S. growth stocks. And it's historically anomalous. It reflects an excessive degree of confidence in the fate of the U.S. economy and these 7 stocks, and it ignores, the classic evidence from looking at diversification of valuation metrics, all of these logical things that you'd observe by studying history.
Interesting. Talk about econometrics. What is econometrics?
Yes. So I started out as a historian, Buck. I wrote a book about slavery called American Uprising. It was my field in college, and I love studying history. And I love studying history because I think you learn from it. You read a biography and you learn what made someone happy or what ruined their life, or what led to a war, and you can start to see these patterns, and maybe you can't quite apply that wisdom in some instantaneous way like you would a self-help book, but I think there's tremendous value in it. And I think the question then when it comes to looking at economics or markets as a historian, right? You say, well, I want to understand the history of markets. Well, econometrics, which is, the use of metrics to look at economic data, that's the way you have to do it, right? That's the way you read the sources. Just like, it might be like, when you go into the historical archives and you open up a microfilm or something, right? Like, no, you open up your tools of econometrics. You look at these long-term regressions and time series regressions, and you start to piece apart or parse apart whether things are truly cause-effect relationships or not, whether events that are correlated are really correlated for a reason or not. And you start to be able to say with more confidence, answer questions like, do really high valuation ratios predict bad things for stocks? So do they, yes or no? Or, how do I think about whether whether a given valuation metric or a given profitability metric predicts anything? Or one of my favorites, can we predict growth with any degree of accuracy, right? So do analyst forecasts or company guidance have any predictive ability? And does that predictive ability translate into stock returns? The answer to which is no. In fact, company forecasts and analyst forecasts have no predictive power for stock markets. But all of these things are the ways in which we derive knowledge from the economic past.
So if you use econometrics, just give us sort of an example of how in an investing system based on econometrics could potentially help avoid, I guess, basic human nature, human mistakes.
Yeah, I think there are, a ton of great examples, but I think the one sort of classic one today, right, is when you think about the stock market, one of the things that you're going to find is if you do sort of think of a 2x2 matrix, where you think of the valuation of the business, and you could have a high valuation or a low valuation. You can be an expensive stock or a cheap stock. And then you think on the other axis, you've got quality, right? Like, is the business generating profit? Is it a high quality business? Does it have sustainable return on investment, et cetera? And you have high quality businesses and low quality businesses. right? And you could say very simply what I want to do or don't want to do. I want to invest in the high quality, cheap businesses, don't want to invest in the low quality, expensive businesses. And if you look at 2021, for example, when there was this huge SPAC bubble, almost all of the SPACs fell in one quarter of that, right? They were all low quality. They were all crappy businesses almost universally, and they were all trading at extremely high valuation metrics. And so I think one of the ways in which you'd use these types of tools is to say, well, based on history, I don't need to study every individual SPAC. I just need to know which box it falls into, right? And if it's in the bad box, I'm not going to put my money into it. And I think so having these sort of simple frameworks is a way of forcing yourself to not get seduced by stories, of saying, because I'm not a master of the universe, I need a set of rules or guidelines to which to guide my actions. I need to focus on developing a process that's rigorous, that's simple, that I can follow, rather than thinking I'm just going to figure it out myself every time I see a new investment.
So do you feel like the econometrics is the spaces that you're talking about for investing? Is that something that, a solo retail investor could realistically use? Or, is that something really that is, obviously you're doing that. Do you need to have full-time professionals who are looking at this stuff to do that? I mean, how realistic is it for somebody to say, hey, I like the idea, but is this something I can do?
I think that the first thing is, econometrics, we've talked a lot about it as a concept, but reduce it to something very simple, which is, can I use simple rules to improve my results as an investor? And can I use rules that are informed by economic data, right? And let's take a very simple one, which is high fees. Right. It turns out that high fees are terrible for your portfolio returns. Wherever you find high fees, they tend to be bad. And so as a simple econometric rule, as an individual investor, you could apply that and say, gee, I don't want to pay very high fees. I don't want to own high fee mutual funds. I don't want to own high fee ETFs. I don't want to pay my financial advisor high fees. I want to find fees that are low or reasonable. Right. And so I can use a benchmark and I can say, gee, let's exclude the stuff that's in the top 25% of fees and let's focus on the stuff that's in the bottom 25% of fees. Right. That's econometric, based on econometric data, leads to very good conclusions, helps inform a simple rule. And I think there are other things like that. You could develop a simple rule, which is said, hey, if I own any individual stock and the price to sales ratio goes above 10x, I should probably sell it, right? So I think that it's coming up with a set of rules like that, and I think that that's actually very accessible to any individual investor. And by the way, not only are all these econometric papers and all these investment papers online already, right? Go read them. There are really smart people on places like X who are writing about these things. And there are even, web tools that'll help you figure out these things yourself. And so I think it's more a matter of, and I think this is there's never been a better time in history to be an individual investor because you're so empowered by the amount of data and knowledge that's being shared on the internet.
If you look at what's going on right now, I think I think there's so much buzz around artificial intelligence. And in particular, as it relates to, the Googles and these companies that are heavily involved with that. I think there are even people who are pretty rational and are looking at those companies and their valuations are starting to think, well, maybe that's pretty reasonable, given all that's going to happen in this sort of revolution. How do you navigate that? To me, again, I'm not necessarily a huge stock investor anyway, but I look at that and sometimes I have the FOMO myself because I'm like, look at AI is going to fundamentally change the way we live. And so, these big companies are the ones that are going to drive it. And maybe I'm wrong to be suspicious of those numbers. So how do you grapple with those kinds of issues?
Yeah. So I think you first asked, am I a conservative investor? To which the answer is no. I think that over time, if you look at the broad history of markets and of individual investors, the biggest mistake has been to not take enough risk. Right. So that's the number one mistake people make. Right. They have too much money in cash. They have too much money in bonds. Right. They've been underexposed to the true wealth creating assets, which happen to be volatile and happen to scare the living daylights out of you reliably once every 3 to 5 years. Right. And so you have to buy them. You have to understand that they're going to be volatile and risky, and you have to own them for the long term. And that's the key to success. So being conservative, actually over a 10-year horizon, is maximizing a lot of risk over that 1-year horizon. And I think that's a mistake that a lot of people make. So I think I'm not neither conservative nor liberal in that sense. I'm rather informed by the data, and the data
No, I get it.
suggests, you need to take on a fair amount of risk in your investment portfolio, but you want to take on the right risks. And I think when you think about AI, and I'll walk through sort of my historian's way of reading this, right? Because rather than saying, I'm going to go deep and read 50 Reddit threads on AI and how it's going to transform the economy, which is sort of my view of the bad way of making investment decisions, which is sort of this case by case, let me understand the story. Rather, I want to have a sort of humble, base rate driven, historically informed perspective. And the right way to do that is to say, well, this isn't the first technological wave, right? We had the 90s internet bubble where the internet was created and fiber was deployed. You can go back to the 1880s when railroads were first created, when that was massive, right? And everyone owned railroads. What happens in these types of innovation waves? And one of the things that you see is that early on, the rewards from innovation accrue to the innovator. So in the 1880s, it was the railroad companies. In the 90s, it was the people that provided internet and then the fiber. And in the 2010s or 2020s, in the 2020s, it's going to be the people that, create the AI models. By the end of the day, the customer actually has to benefit more than the innovator, right? Because the customers aren't going to pay for the AI unless the benefits to the AI are more than they paid for them. So in theory, the size of the benefits needs to be bigger than the profit pool to the innovator. And so the second wave is actually the customers benefiting, right? The people that take the railroads, the industries that ship their stuff over the railroads, the people that use the internet, the people that use the AI models. And that shift actually happens quite quickly because there's so much competition. People build too many railroads. They put in too much fiber. Think about how many different AI models there are. There's Claude, there's Grok, there's ChatGPT, there's Gemini, right? Right? Everybody's building, and they're basically the same model, right? How many of them do you need, right? Everyone's building their own, but do they really need their own? And so there's clearly a massive overbuild. And the question is, when that shakes out, the customers are definitely going to benefit, right? AI is great for me. I'm sure it's great for you. It's great for many of the people listening to this podcast. But is it necessarily going to be great for both Google and ChatGPT and the people that do Claude and the people that do Grok? No, it's not. And some of their stocks are going to be disasters. And so, how are you going to pick the winner, right? You might have picked, meta search or whatever it was, and then Google just blew them out of the water, or Ask Jeeves or Yahoo, or right, those were the leaders at one point. And I think that's the problem with these innovation waves, is that you got to pick the winner. You got to pick the winner, and that's really hard to do.
How do you approach that though? I totally get your point. Again, you can go back to the .com era and say, well, gosh, that was a disaster. Well, yeah, it was, except there was also some companies that came out of that, like Apple and Amazon, that if you had exposure to, you did really, really well over time. So what's your best chance at getting exposure while mitigating the downside in a new technological boom?
I think that the reality is these new technology booms tend to involve too much optimism, and thus tend to be traps for investors. You want to be investing in things that people are pessimistic about, not things that people are optimistic about, as a general rule. And one of the ways I went and looked at this is, and in the Humble Investor, I have this chapter where I call it investing in a bubble. And I went and read the investor letters of most of the great hedge fund managers of the 90s. And all of them knew that the tech bubble was a bubble. The only problem is that they knew it in 95, 96, and 97, and the bubble didn't burst till 2000. They were all right. They were all early. They all suffered in 97, 98, 99, because they didn't own the sort of fad assets. And then all those assets crashed in 2000, 2001. And if you just own the value index, if you'd owned, any diversified index, you would have ended up outperforming the NASDAQ or, the companies that were sort of the big fad companies, even though you were 10x literally behind in 1999, because the crash happened so fast. And so I'd say, you don't, today, it's not hard. It's easy to get exposure to AI, right? Just buy the S&P 500. You've got so much AI exposure. There's no problem gaining AI exposure. It's easy. I think the question is, how do you not have FOMO? How do you stay out of that stuff? When you're when it so obviously seems like the right thing to do and people are so optimistic about it? What are the things that people are pessimistic about? I personally think that today the great opportunities are abroad, in Japan and Europe, places that people are so pessimistic about, but they're still equities, right? They're still equities. They're just really cheap equities relative to the United States, where you've got really expensive ones.
Sure. Last question for you. What's your take on your own view on sort of the Trump presidency coming in, how the markets respond? Just sort of, there's a Trump factor that seems to be there, regardless of any econometrics per se. Markets are kind of going up just based on him. Just any broad thoughts as he comes in?
I think, when you look at 2016, and we did this analysis, I think in 2015 or 2016, Trump had these big tax cuts, corporate tax cuts planned, right? And if you actually looked at the impact those tax cuts would have on the net income of corporate America, it was so massive. And so stocks just went through the roof after that, right? And they went through the roof because actually net income just rose substantially because of lower tax rates. And so I think people associate, and then he did all these clever things around how people expense investments that encourage people to invest more. That investment led to more growth. It was just massively stimulative. And I think people are looking back and saying, if anything like that happens again, we've got a lot to look forward to. It doesn't appear that, if he lowers corporate tax rates again, it would have a similarly stimulative effect. And the other thing is that deregulation is also very stimulative. So there's a rationale there. I think a real economic rationale, right? These things are good for the economy. They are good for the stock market. My fear is that they're just excessively priced in.
Sure. Got it. Tell us a little bit about your firm.
Yeah, we are a quantitative investment firm. We manage a little over $1 billion in assets. I started it in 2014 when out of my dorm room at Stanford Business School, and I've been running the business since. But our main goal is to apply the lessons of history to try to develop products and strategies that are based on long-term historical data. And logic, and we provide that service to foundations and endowments and family offices and a wide variety of other clients.
Got it. And the company, again, is called Verdad. That's VERDAD. And the website is verdadcap.com. Thanks so much for being on the show today. It was very, very interesting stuff. One more thing, plug your book here real quick. It's The Humble Investor, How to Find a Winning Edge in a Surprising World. And I assume you can get that on Amazon anywhere, pretty much. So
absolutely. Thank you, Buck.
Fantastic. Look forward to reading it. Take care.
Bye.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for, and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back, everyone. Hope you enjoyed the show. And before we go, I just want to remind you that once again, if you'd like to participate in any of our upcoming opportunities, you can do so if you are an accredited investor and you get onboarded with our accredited investor group called Wealth Formula's Investor Club. And that, of course, you can sign up at wealthformula.com. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.